Today, we're taking a closer look at one of the largest IPOs in U.S. history, and that is, of course, Uber, which sold over $8 billion of its stock late yesterday and will begin public trading today. We welcome now Kathleen Smith, Renaissance Capital Principal and IPO ETF Manager, and Ygal Arounian, Wedbush Securities Internet Analyst. He has an outperform rating on Uber with a price target of $85, which is a lot higher. $85? $65. $65. Yeah, I misread that. Boy, don't want to push it too far. So welcome, Ygal and Kathleen. Good to have you both here.
Thanks
so they did get it out and they sold it, but at the lower end of the range.
Yeah, thinking that makes sense. You got to put it in the context of what happened with Lyft. I think they took a real good lesson from Lyft's experience coming out of the gate, shares trading up and then really being weak ever since then, even weaker after they reported their first quarter earnings. Then kind of layer on the choppy trading we've had this week just from the macro noise. And I think it was a smart move and prudent move to come out at the lower end of the range.
Do you think that Uber officials, Uber executives were tearing their hair out as they watched the market sell off ahead of this much anticipated open?
Yeah, well, as you know, it's difficult to time the market perfectly. I'm sure they weren't thrilled about the news this week and the way the market's been trading. I think they were a little bit more focused on Lyft and learning their lessons from how Lyft came out of the gate than some of the noise this week, but it certainly didn't help.
So besides the absolute dollars, as I understand it, we basically are valuing this based on multiple of revenue. How does Lyft compare with Uber on multiple of revenue?
Well, right now it's trading below where Uber is. So Uber's, we evaluate on a sum of the parts basis, but at the end of the day, it's still trading at around 5 times revenue. Lyft, with the way it's been trading, is well below that. It's trading below 4 times revenue. We think Uber deserves a premium for its global nature, the fact that it's in multiple businesses.
Because it has more parts to sum up.
Well, right? That's true. I mean, Lyft only has one part to sum up. It's only domestic. It's only rideshare. Uber is global. It's in multiple businesses, and it's the leader in every region that it's in, and that makes a difference.
So it has a lot of parts to add up. They're not adding up to profit in any way, shape, or form. In fact, it is burning through cash at some of the fastest paces ever seen in an initial public offering. So, Kathleen, from an investment standpoint, is this a good buy?
Well, our studies of the IPO market, and you know that we cover the market and we run this IPO ETF, we have looked at the most money-losing IPOs that have ever been done in history. And that's, you've lost the most money prior to the IPO in that year. Right now at the top of that list is Uber. The second company is Lyft. Snap is on that list. Groupon is on that list. And we studied how the stocks performed to date from the IPO price, and it's not a pretty picture. So a lot of losses are very hard for investors to sort of absorb in their thinking on valuation. And I do agree that Lyft is just a very important, the little brother to Uber, who's really, and I think their biggest disappointment for Uber is Lyft's, when they announced earnings, took another 10% drop because investors were very concerned about their continuing losses, and they're significant, $1 billion or so coming up for 2019. So this is going to be a hard IPO to absorb from the losses. And then just looking at overall all IPO activity, it's a very large IPOs. It's one of the top 10 IPOs in terms of size. And large IPOs are also challenging to absorb in the market. We know what happened when Facebook first came out, and we know Google. So we know from looking at the IPO market that these very large IPOs can be problematic just in getting launched. But as Trump said today about the China trade, there's no need to rush. I would apply that as well to the IPO for Uber.
So, Ygal, nevertheless, you have an outperform on the stock. You think it should be $65 rather than $45. How does one separate out it's a really good deal in the sense it's a good company that is going to make money at some point? You got to make money at some point or it's not worth it, right?
Right.
From just people are searching for some place to put their cash. I mean, it goes back a little bit to the Blackstone private equity. People are searching for yield anywhere they can find it.
Yeah, that's a really good question. And I think, to your point, I think that was part of the problem with Lyft coming out of the gate, where people weren't necessarily searching for a place to put their cash right away. Maybe initially, but kind of after the noise that from the trading after the first couple of weeks, I don't think investors really had a big rush to put their money into Lyft. I think a lot of people were kind of waiting. Let's see what happens with Uber, and once it comes out of the gate, see how that does. I think that gives Uber actually a little bit of a benefit. Lyft felt like it had to come out first because it was the little brother and needed to set that precedent. Uber had the benefit of being able to sit back and let that play out before they got in. I think that's going to help them ultimately.
Well, and when we talk about Blackstone and all the private capital, that's what allowed Uber to come to market with an initial public offering as late in its cycle as it did, right? And I have to wonder what we have seen with Lyft and Uber, what that means for some of the other tech IPOs that are coming out later this year or that are thinking of, including Slack, Peloton, Airbnb. Kathleen, what do you think?
Well, I think the very important point is that where there's a whole lot of capital is in the private market. And because there have been so much capital showered on these companies, the valuations you look at it from a public market perspective and say, how is it possible that these companies can be valued at these levels? And we are seeing in the way they come out in the public market that sort of disconnect resolve itself. So we continue to think that there are companies, for example, WeWork is on the calendar. WeWork is losing so much money. How are we, and has such a high valuation? How is the public market going to figure this out? So it will be the resolution of this, and I think maybe this is the time for the private market to sort of say, look, maybe it's a little overvalued. Maybe we should be careful about how much money we're throwing into this illiquid market when I can't get liquidity unless I come out at a lower price and cutting out last rounds of valuation.